Hi folks, my name is Mansoor Suhail. You may call me Manny for short. I'm an accountant operating out of Scarborough, Ontario. My specialization is taxation for Canada and USA. I will be talking about financial modeling and valuation today. My today's presentation is just for educational purposes only. So our topic today is modeling, financial modeling and valuation. Um, what are the requirements or what goes into financial modeling and valuation? And the first thing we need to look at is income statement. So what is an income statement? All businesses are required to report sales and income over a taxation year. Profit is when we subtract expenses out of sales, and net income is when you subtract taxes out of profits. So here are some of the categories that go into income statement. We have sales, cost of sales, gross profit, operating expenses, other income, depreciation and amortization, interest, taxes, extraordinary expenses, and distributions. So what are sales? Sales or gross income of a company is called revenue. Revenue recognition has a big importance. It is recognized when earned. That is, once the products sold are transferred or services are rendered. Next comes cost of sales. These are costs that are directly related to production of goods. Most of the time, it is cost of the material that is used in production of an item for sale. Gross profit. When we subtract cost of goods sold from total revenue, we get gross profit. Gross profit margin is gross profit divided by total revenue. So let's look at an example of gross profit. Sales of a clothing company in its first quarter is $500,000. Let's say the material that's used for this sales is $200,000. Our gross profit is sales minus COGS, that is cost of goods sold. In our case, it's $500,000 minus $200,000 gives us $300,000 as gross profit. So what is our gross profit margin? Gross profit margin is $300,000, that is the gross profit, divided by total revenue, which is $500,000, and that gives us 60% gross margin. Let's talk about operating expenses. Cost of normal business operations is called operating expenses. Selling expenses, general and administrative expenses, research and development expenses are all examples of operating expenses. Let's look at an example. In our example of clothing company, let us assume the following. Selling expenses equal $100,000, advertising expenses $50,000, research and development expenses $50,000. So our total operating expenses are 100,000 plus 50,000 plus 50,000 equals to $200,000. Other income. Other income is not a part of revenue because it is not related to main activities of a business. So what could be another income? Other income could be interest earned from financing. Other income could also be income earned by having a non-controlling interest in another corporation. EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. Formula for EBITDA is revenue minus cost of goods sold minus operating expenses and other income. Other income usually has two arguments. Some say it should be added in EBITDA or it should not be added in EBITDA. If other income is consistent, it should be added to EBITDA, otherwise it should not. Financial and lending organizations have different views about exclusion or inclusion of other income in EBITDA. Sometimes different industry groups within the same organization have different views on exclusion or inclusion of other income in EBITDA. Let's look at an example of an EBITDA. In our example above, our sales are 500,000. Cost of sales is 200,000. Gross profit is 300,000. Total operating expenses are 200,000. We get income by subtracting operating expenses from gross profit. Therefore, our income is 300,000 minus 200,000 equal to 100,000. Let us assume other income is 2,000. EBITDA is 100,000 plus 2,000, which is 102,000. What is the EBITDA margin? EBITDA margin is EBITDA divided by total revenue, which in our case is 102,000 divided by 500,000, and we get the answer of 20.4%. EBIT. EBIT is EBITDA minus depreciation. So let us assume that depreciation in our example is 2,000. EBIT is 102,000 minus 2,000 gives us 100,000 as EBIT. EBIT margin is EBIT divided by total revenue, which in our case is 100,000 divided by 500,000, leaves us with 20% margin. EBT. EBT is earnings before tax. Earning before tax is EBIT minus net interest. Let us assume interest expenses in our example equal 2,000. Our earning before tax would be 100,000 minus 20,000 equal to 80,000. Taxes. Business earnings are subject to taxes. Let us assume that our tax rate is 25%. Taxes due in our example would be 80,000 times 25% equals to 20,000. Depreciation. Fixed assets deplete over the years. Accounting for aging of assets is called depreciation, and accounting for aging of intangible assets is called amortization. Non-recurring and extraordinary items. These are expenses or income that do not occur frequently, and these are not related to main line of business. Gains or losses from sales of an asset is an example of this. Usually these items are mentioned separately after EBITDA and EBIT. Distributions. These are payments distributed to shareholders. Distributions are made in the form of dividends or interest. Shares. Basic shares are the shares outstanding in the market. Diluted shares are the number of shares outstanding if all possible sources of conversion, such as convertible bonds and stock options, were exercised. Earning per share. Earning per share, basic earning per share is net income divided by basic shares outstanding. Diluted earning per share is net income divided by the number of diluted shares. I have done this research from the book Financial Modeling and Valuation, written by Paul Pignataro. Thank you for watching this video. I hope you have enjoyed watching this and learned some important concepts about income statement.